All right, let's talk about something big today. We're diving into a really powerful strategy that's all about giving a child a true financial head start. And I mean, one that goes way beyond just saving for college. This is a concept that could genuinely reshape their entire financial life.
I mean, this is the question, right? It's on the mind of pretty much every parent, every grandparent. We all want to set up the next generation for success. But how do you actually do it? How do you build a real strategic foundation for them? For most of us, when we think about saving for a kid's future, one thing immediately pops into our heads: the 529 plan. It's the household name. You ask almost any financial expert, and it's the first thing they'll bring up. And for good reason. So let's just quickly break down this standard playbook, because it's important to understand what it does so well. The 529 is actually pretty straightforward and, honestly, very effective. You put in after-tax money, it grows, and as long as you pull it out for things like tuition, books, housing, it's all completely tax-free. For pure education savings, it's a fantastic tool. But here's the catch. Its biggest strength is also its biggest weakness. It's built to solve just one specific problem. And because it's so hyper-focused on that one thing, it leaves another really crucial financial risk totally exposed, one that most people never even think about. And this, right here, is the key idea that the standard playbook completely misses. What happens if your kid develops a health issue when they're, say, 15 years old? All of a sudden, their ability to get affordable life insurance, or maybe any life insurance, as an adult could just vanish forever. This whole concept is called insurability, and locking it in for them is one of the biggest financial gifts you can possibly give.
And look, this isn't some far-fetched, abstract risk. We're talking about common conditions that often show up in childhood or as a young adult. Things like type 1 diabetes, certain heart conditions, autoimmune diseases, even some mental health issues can make getting life insurance later incredibly difficult, if not impossible. And that can create a huge financial vulnerability for their future family down the road.
So this brings us to a completely different way of thinking about this problem. It's called the million-dollar baby strategy. And this approach is designed to solve for both college funding and that hidden risk of insurability.
Okay, the big idea here is that we have to totally reframe how we think about permanent life insurance for a child. Forget about the death benefit. That's not the point. Instead, I want you to think of it as buying their very first real asset, an asset that does two incredible things. It locks in their good health forever, and it builds a financial tool they can use for their entire life.
It really is a two-for-one deal. First, you guarantee their future insurability. Doesn't matter what health problems pop up later, they're covered. And second, you're building a cash reserve that grows tax-deferred and can be accessed tax-free for, well, pretty much anything, not just school. Now, the magic that makes this all possible is a special feature called a guaranteed insurability rider. Honestly, think of it like a golden ticket. It gives that child the contractual right to buy more insurance later on in life, like when they get married or have kids of their own, without ever having to pass a medical exam again. Their good health as a kid is locked in from day one permanently. Okay, so that handles the insurability part. But what about the other half of the strategy, the growing cash reserve? Let's look at the two main engines that can power this thing. So you've basically got two main options here. You can think of whole life as the solid foundation. It's predictable, it's got guaranteed growth, it's the slow and steady tortoise. But then you have indexed universal life, or IUL, and that's the growth engine. Its growth is tied to a market index like the S&P 500, but, and this is so important, it comes with a safety net, a 0% floor. That means even if the market tanks, your cash value can never, ever lose money. You get the upside, but you're protected from the downside. And it's that combo of upside potential with downside protection that makes an IUL so incredibly powerful for long-term growth. I mean, just look at this quote. Because of that market-linked growth, you're looking at potentially 2 to 3 times more cash building up over a child's lifetime compared to a more traditional whole life policy. That's a huge difference. So, all of this growth creates something really special. It becomes a flexible, powerful financial toolkit that your child can use for their entire life. And you have to see the power of starting early. It's just staggering. A pretty modest contribution, just $100 a month for the first 20 years, can grow into over $1.3 million of tax-free income for them in retirement. That is the absolute magic of compound interest when you give it the longest possible runway to grow. And remember, unlike a 529, this money isn't just sitting there locked up for one specific thing. This timeline here shows how it basically becomes their own personal bank for life. At 25, they could take a tax-free loan for a down payment on their first house. At 35, maybe they use it to launch a business. It's there for all of life's biggest moments, and the whole time, the asset just keeps on growing in the background. So let's just put these two strategies right next to each other. With an IUL, the funds can be used for anything you can think of, tax-free. A 529, education only. When it comes to financial aid for college, an IUL typically doesn't count as an asset, which can be a huge advantage. And of course, the big one, it solves that hidden risk by guaranteeing their insurability for life, something a 529 just wasn't built to do. So at the end of the day, the choice between these tools really isn't about which one is better. It's about taking a step back and figuring out what problem you are actually trying to solve.
So here's the final question you really have to ask yourself. Is your goal just to solve for a specific tuition bill that's coming up in 18 years? Or is the goal to hand down a protected, growing financial asset that gives them security, flexibility, and opportunity for their entire life? Once you answer that question, I think the right choice becomes a whole lot clearer.